Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of THOR Financial Technologies and Portfolio Manager of THLV, the THOR Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Paul Weisbruch. He is from GTS. They are a market maker for ETFs as well as individual stocks. They are front and center down on the New York Stock Exchange. It was nice to talk to Paul today about the ETF industry as a whole, what they do as market makers, as well as what it takes to really make an ETF launch successful and to go smoothly and to have longevity in this business. So it's a wonderful conversation with Paul. So please enjoy this episode with Mr. Paul Weisbruch. Hey, Paul, welcome to the show.
Hey, thanks for having me, Brad. I appreciate it.
So can you tell us a little bit about your background and how you eventually made your way to GTS?
Sure. I've been involved in the greater ETF ecosystem since the early 2000s, somewhat by happenstance when I was at Susquehanna. At the time, I'd started there on the NASDAQ OTC market making desk and had an opportunity to go down to the Philadelphia Stock Exchange and work on the specialist posts for SPY and DIA, the diamonds. And at that point in time, this is call it early 2000s, there was only a handful of ETFs. Spreads were rather wide. Volumes were certainly relatively low compared to what we see today. And there was just, I don't know that there was a vision that there would be 3,300 ETFs and mutual funds converting to ETFs and the progression that we've seen over the years and major asset management firms going into the space. No one was talking about any of that, really. These were just fairly straightforward market index beta funds that had traders' interest, the interest of hedge funds, and certain managers were using them. But I think this was well pre-ETF model, ETF strategist, ETF fund of funds. None of that was really populated, and not too many firms were doing it at the time. So fast forward the clock a bit, I then spent some time at an ETF issuer, Pacer, in 2008, 2009 timeframe. And obviously their actions speak for themselves in terms of, I believe they have $25 billion in assets at this point in time, a decade later, and a broad lineup of funds. So I saw the merits of being a startup, the challenges of being a startup in the ETF space on the issuer side, but have a good awareness of the distribution network and needs that advisors have and institutions have and what they really look for when screening and adding ETFs in their investment portfolios. So I joined GTS in 2019, post the acquisition of the market making group and lead market making commitments from Cantor Fitzgerald, and proud to be a member of Reggie's team, who has been in this space longer than I. I would say since the late 90s, the team here has broad expertise in market making, both on floor-based trading as well as upstairs electronic trading. And currently, we oversee 341 U.S. listed ETFs as lead market maker. Add another 40 as secondary market maker. And we trade across the spectrum well over 3,200 of the U.S. listed ETPs. So we have, very broad asset class expertise and ability.
So, Paul, I always like to ask everybody before we jump into things, what do you like to do when you're not, what do you like to do outside the office? What are some hobbies you have?
Sure. Hobbies, one is certainly music. I enjoy to play and listen to music, and it seems to be easier than ever, to download albums and create playlists and store thousands of songs on something like YouTube Music, which used to be Google Music. So that's the technology fascinates me, the ease of use, and the sheer memory of having something that's just it's just well advanced compared to, say, like the iPod that everyone had just several years ago, and 500 songs was something to be fascinated about. Now it's more like you could have 100,000 songs, full albums, and what have you on your phone. That's probably number one, and number two, I would say basketball, swimming for the most part.
So,
Something both things that I ironically picked up, well after high school and college.
so have you talked to or been introduced to David Schulhoff, who runs MUSQ, the music ETF?
Yes, sir. We are lead market maker in MUSQ. I should add, we're also lead market maker in Tune, TUNE. And those are the only two music industry ETFs that I'm aware of, both pretty new to the landscape. Within the last 6 months, both launched. And some of the points I touched on earlier about YouTube Music and the progression of the electronification, if you will, of MP3s and such is certainly core to what they're doing in their respective spots and running those ETFs. I actually saw him recently at the Future Proof conference in Huntington Beach just several weeks back. Which,
Yeah,
ironically, the conference had a music bent on it. Obviously, there was live music on the final day.
yeah, I had him on the show actually a few episodes ago. He's a really interesting guy, cool background. I also saw him down at Future Proof. You and I didn't run into each other, and I was at that concert the final night.
Right. Yeah. Likewise. I mean, the whole live music aspect at that conference is obviously something unique, and I think David bounced some ideas off of me in terms of where the idea for the fund came from, where the idea for his company came from, and where he sees the future. And it's all things that I haven't even considered, which I found fascinating.
So let's talk about GTS itself. Can you explain to me and to the advisors or somebody who's going to be coming to issue an ETF here, what exactly GTS does, in as simple as a format as you possibly could?
Sure. So when an advisor is seeking to launch an ETF, if we take into account that they've already selected an exchange, New York Stock Exchange, NASDAQ, SIBO, GTS will provide the initial seed capital because to fund a new ETF, you need AP/market maker seed. That's a service we provide, in essence, placing the first seed order so that the fund reaches the exchange's listing requirements and can launch. There are some funds that are self-seeded in the sense that they're a mutual fund conversion with assets or an SMA in-kind transfer with assets. But that aside, for those new ETFs that need to launch and they're not a conversion, we provide the seed, and then we agree to be the lead market maker on the respective exchange that they choose. And that means that we're required to post reasonable bid offer quotes during all market hours every day of the week. So 9:30 to 4 o'clock, we have the responsibility to be posting continuous quotes, i.e., we can't take a break and there shouldn't be any gaps in time where we're not quoting, or any gaps in time where we're wide compared to where NAV is. So, barring system outages or street-wide market data issues, you'll see our quotes bid ask for 340 some odd names right now, and ideally hugging the NAV, trying to provide liquidity for orders that come in electronically as well as from upstairs sources such as broker dealer desks or custodian desks when they're transacting in ETF blocks for models for advisors.
So what is it about GTS specifically that allows you guys to win so much business? It seems like as a, we use you guys as our direct or floor trader now, but what is it about the GTS that's unique to you guys, or something that you offer that allows you to get so much of this new issue business?
Yes, I think it's a perfect combination, if you will, of cutting edge technology and speed and awareness of future needs on the technological front, and that coupled with boots on the ground experience with different types of clients that are trading or managing said ETFs. So we understand the needs uniquely of a broker dealer block desk that's trading for thousands of advisors internally for models versus the needs of an RIA ETF strategist who runs an ETF model versus, say, an institution that trades ETFs as just part of their strategy. Perhaps they're stock and bond pickers by nature, but when they trade those ETFs, because of the sheer size of the institutional plan, the blocks are large enough that they certainly don't want to create price impact. So I think that we have fairly broad expertise, and that's from just being in the game for so long, in speaking with different clients and what their specific needs are, and are oftentimes in a consultative role in terms of examining a portfolio's liquidity, examining which ETFs they currently own or seek to buy, and finding if there are anything, any esoteric details that we should bring to their awareness in terms of product nuances or product pricing or differences from fund to fund. I think it's a combination of just being in the trading space, the market making space, as well as many of us on this team have ETF wholesaling backgrounds. And once you can break down the barriers of what the various brokerage firms look for in terms of what makes an ETF successful and added to said platform, you can connect the points of distribution to actionable trading liquidity. And obviously, volume and assets tend to drive the success of ETFs, more so than performance, I might add.
Yeah, and I definitely want to talk about that a little bit later. You mentioned their technology. I was just there with you on the floor a couple of weeks ago, or last week, I guess it was. How has technology changed, even in the last 10 or 15 years in terms of market making and trading, and kind of where do you see it going, even with the advent of AI, and will that have any impact on your business?
I think that you'll continually see the need for auto quoting technology and automated technology, especially with a bevy of dozens of more ETFs and different types of products coming to market. Even though there has been a wave of liquidation, some of the smaller funds with lower asset bases have closed in 23. I think you'll see the net number after new ETF launches, which includes mutual fund conversions and SMA in kind transfers, is still a positive. So it's very realistic for me to say, at some point in the next 3 years, there likely could be 5,000 ETFs, especially given a lot of the new ETFs will be existing strategies that have converted from their current form into an ETF. Long and the short of it is, it brings a higher level of sophistication of these products and strategies to market, because some of the products that are launching are not, they're first in class, brand new concepts, if you will, to ETF world. Ether products, for example, this week, I saw an aluminum strategy from U.S. commodity funds launching this week, as well as the bevy of active managers that simply have high asset totals in their existing strategy, and the fund has a following and has a retail investor base that will trade it. All of that needs to be supported by better technology, technology that will continue to advance day over day, week over week, quarter over quarter. I think one example is the you alluded to this, the New York Stock Exchange DMM model, which a fund company can now launch on the New York Stock Exchange as opposed to the electronic ARCA. And there are certainly merits to that. You have a human overlay, if you will, on top of an auto quoter or an algorithmic based quoter. And generally, there's more market depth, tighter spreads. The optics of the fund tend to be very positive, especially for newcomers that are looking at a new fund. And typically, the advisors have the same questions. They usually look at spread, volume, and then the newness of the fund. Is it a month old, or does it have a 5-year Morningstar record? If the optics of the fund going into a trade are positive, i.e. tight spread and some level of activity and some level of market depth, chances of said advisor making a sizable allocation are higher. So I think we can speed that process of launching a fund and then getting to success points, 50 million, 100 million, a billion in AUM, vis-a-vis conversations about mechanics optics and real life scenarios, such as buying 10x, 20x the average daily volume in said product. So I think that the human overlay, if you will, on top of what we're doing technologically in our quoting systems, whether that be on NYSE floor or ARCA, NASDAQ, or SIBO, because we were active on all of those venues, is certainly important. Understanding that certain asset classes and certain products are unique from fund to fund is probably core to that, and each needs a special level of attention and special level of detail to be successful.
So, staying on this kind of like DMM and floor trader touch and feel, you know, I can attest to all the positives that has brought us as a firm, and in our product. So, if you're really any type of issuer, but specifically a smaller issuer, I can't recommend making that transition or launching that way from the start. But the question really is around, two questions here. One would be, everybody sees the floor traders, can you just kind of give everybody, what are they doing all day? And what kind of unique skills does a floor trader need in order to do their job?
Sure. On the floor, it's important to recognize that the specialist books consist of single listed equities that are on the New York Stock Exchange. Many of them well-established S&P 500 companies where there's obviously quite a lot of demand to trade said names on a daily basis, whether it's index-related trading or just sheer shareholder retail interest, something like an IBM or a Disney or a JP Morgan or a Boeing. Obviously, all these stocks trade on NYSE, and there has to be a specialist floor trader maintaining the books. The core of the specialist job is to always be providing two-sided quotes and liquidity and an orderly market, especially in times of news or market volatility. And it's still required, even though the order flow may be going against the specialist's book, they have to provide liquidity. It's not an issue of, is the specialist losing money or making money to the trading. And oftentimes, the only real bid and liquidity around is the floor specialist trying to maintain that orderly market. So in times of market stress, where there's one-way selling or one-way buying, for that example, for example purposes, specialist is the first stop in terms of quoting and keeping orders that are coming into the marketplace trading at reasonable levels, and also matching buyers and sellers where necessary. They have an acute awareness of which firms may be active and at certain price limit levels, and in certain cases may be able to match buyer seller, as well as take down positions for the sake of stability and liquidity within our own book.
So let's pivot to like kind of launching an ETF. And from your perspective, I would like to take a little look behind the scenes when you're getting ready to take on a new issue to market. What has to be done before trade day, then what has to be done kind of on the day of launch?
Sure. Before the launch itself, before the first day of trading, we would highly recommend any clients that the issuer is in touch with and their expectation to be active in the fund in early days of trading, simply just to check in with their custodians, whether it be a Schwab or Fidelity or an LPL or Raymond James, just to make sure that the ticker and the new QSIP is available for trading. Sometimes these things aren't set up until post-launch, simply because it's a function of advisor demand or not. But it pays to make these calls and figure out the landscape before launch so that there's not a mad scramble or no lost business for no good reason other than, RIA tried to place order in new ticker, but it was rejected because it wasn't added to the master database at firm level. That does happen, and it's unfortunate because I feel like the average ETF issuer probably doesn't know it's happening, and it sometimes becomes a sheer function of numbers. There's just dozens of new launches, 3,200 and more to come, ETFs, and the workflow just can't be managed day to day without some human awareness and interaction. So I think one of the most important things to do is just make sure that your points of distribution, where you plan on selling the fund, that those gateways are open. And sometimes it's simply just adding a symbol and adding a QSIP to some master database and having it in there. I think a second point would be simply um, having a capital markets team internally, if not outsourcing that to a trading sub advisor is an important role. It's worth the investment. It leads to successful launches, but not just launches themselves, but day to day, week to week efficiency. So having a team internally or one that you hire, and there's obviously several third parties that are very competent at this. They can watch for anomalous volume in the ETF. If spreads, which tend to be pretty consistent, ever move away, they can quickly ping the lead market maker and just ask a quick question or find out if there's a basket anomaly or perhaps some names in the basket have news or are halted or something like that. At least get to the bottom of it quickly and figure out why is the spread outside of normal parameters. If that's handled within seconds as opposed to hours or days by said ETF issuer, you're simply just running a better product. You're running a more efficient product. You'll have less advisor questions and inquiries and just a tighter process overall. And I think all that just leads to better sales. It simply just
Right.
leads to a mature result with we have tight spreads, we have acute awareness of our products, how they trade minute to minute, day to day, and it could become cumbersome to add funds over time, especially if they're different asset classes and they have different trading characteristics if you don't have like an internal way of monitoring it all. So growth is obviously a good thing. Scale is a good thing. Adding new funds all the time is a good thing. At some point, that day-to-day labor may outstrip your current, backbone of support. So we definitely see those that are successful, like I said, either investing in their own capital markets team or subbing it out. But I think the notion of well, we have advisor interest in new ETFs and we have assets we think these will be successful if we distribute them. That's all great, but I think there has to be a plan before day one of if any of the above take place. How do we support growth? How do we support
Right.
incoming calls? How do we support market maker questions? How do we support anomalous trading? Do we have a plan? All those, if all of those boxes are checked, I think you're on the path to success.
Yeah, we talk about that a lot internally about making sure we're institutionalizing the business, right? And having all those boxes checked because as we kind of get down the line and I want to talk about scaling an ETF company, but it's important to have all those boxes checked ahead of time. And so you're not chasing yourself later. When we launched early, we weren't aware of kind of the issues that can happen in the first 15 and last 15 minutes of trading and kind of those auction times, as well as how certain things can go wrong in those periods. And we had to learn fast and learn quickly and make adjustments. So you're right. I mean, having all those boxes checked on day one is extremely important.
I like the term that you use there, Brad, institutionalizing, the business, because I think that's what it becomes in terms of whether it's a firm that's known for one or two niche funds, but they're successful and they raise assets, or a growing lineup of, broadly diversified funds, fixed income, long short commodity, long short equity, maybe some dividend value growth type equity ETFs. Obviously, there's a lot of broad based companies that kind of have something for every season, and for the full tactical or strategic manager. Yeah, I think the issue is do we have dozens of funds? Do we have hundreds of funds? How do we support it internally? Because on any given day, something anomalous could happen to one or more of them. Largely because the ETF business, it's not necessarily easy to track where volume is coming from.
Right.
It's kind of if it's model based action and you understand that your funds are being added or subtracted to models, there's some awareness of that and some way to track it, but even that is done quietly and without footprints in most cases, and it's usually an after the fact observation. And then the thing comes down to your shareholders, which could be institutions, retail advisors, could be retail investors, self-directed. they're not necessarily emailing the sponsor and calling the sponsor and saying, hey, tomorrow I'm going to allocate $5 million to XYZ. So get ready and, make sure that our orders are executed correctly. I would say a small percentage actually give the heads up to the ETF sponsor or the trading firm, market maker that's involved in the fund. The more that do, they get a great outcome because all eyes and all attention is on to what they wish to do. But mystery volume, as I call it, it's hard to address when you don't know where it's coming from, and
Right.
oftentimes it catches people flat-footed. So I would say, all of the time we're trying to model better and prepare ourselves better for scenarios where average daily volume in a certain fund that's usually quite inactive will jump considerably, and then trying to track where that's coming from. Usually it's model driven.
So we talked a little bit about launches. Just from your perspective, what sort of trends are you seeing in ETF launches that are coming to market? I've seen a lot of kind of niche products, also a lot of active products. What are you seeing on your side of the desk, actually taking these products to market, where things are going?
Sure. Yeah, a couple themes jump out at me. Some of them may be very obvious, but as the crypto regulation warms up from a regulatory standpoint to what issuers are looking to do, there's a long line of ETF sponsors that are jumping into the crypto futures and ultimately looking to run spot crypto ETFs. That seems like an obvious one based on the progression in the last couple of weeks and seeing the filings as well as launches from firms like ProShares and Grayscale and Van Eck and Valkyrie and so on. That's number one. I think number two is continued growth in the buffered defined outcome space. It took several years for the first $1 billion buffer, but it seems like once that happened, not only are there more players in that space, but there's hundreds of funds from various providers, Innovator, First Trust, Pacer, TrueMark come to mind in terms of Allianz, all have defined buffer outcome products. BlackRock has them now too. So there's new entrants, there's existing players that have been around for 5 years now in the space, and the assets are exploding. And I think why? Because the retail base of advisors and institutions that use these have confidence now the products are traded and structured, and they suit a need. They suit a need within portfolios. So I think you'll continue to see options-based or options overlay ETFs, whether they're defined outcome buffers or something like JEPI from JP Morgan. There's no shortage of funds in that space now, too, all within the last 2 or 3 years. So it's gone from like a fund category of relative obscurity to something that has billions in assets and growing, as well as new filings. Single stock ETFs, long, short, with leverage, continue to be, I wouldn't say hit or miss necessarily, but there's some that are immediately successful given good timing and the popularity of the single stock. NVIDIA, Tesla come to
Right.
mind. And then there's other single stock ETFs, which are quite small, but the providers, I believe, think that the single stock name will be in play at some point in the future. So they want shelf space there. Again, no shortage of new funds coming to market in that category. Literally, dozens, if not in the pipeline that have launched already.
So I'm going to ask you a loaded question. It's a simple question, but what do issuers have to do to survive in this business and scale?
I like the question, first of all, because I think we do a lot of thinking about this. The number one thing that comes to mind is differentiating between soft circle assets, if you will, and actual commitments to doing business in the first 30 days after an ETF launch. And that's the primary driver. I feel like if an issuer can come to market with high confidence they can raise 50 million in 30 days, some of that may be internal via their RIA or other SMA strategies that they manage, and convincing said investors that this new ETF is a better fit for our business and for you. Let's transition into it. So that comfort level needs to be established quickly, and it needs to lead to action quickly. Second of all, everyone has some level of pre-launch marketing, which is obviously within compliance of their new ETF strategy. and advisors will either be committed or will wait and see. If it's wait and see and they want to wait until said ETF has 100 million in assets, has a million shares a day on average daily volume, that becomes a bit of a dice roll for the issuer in terms of they're waiting for someone else to buy first. And it is a chicken and the egg scenario, which could lead to managing a fund with low assets month over month, quarter over quarter, waiting for others to appear and buy it. And you have, basically a bunch of retail advisors that are waiting for activity to happen outside of them before they get comfortable. So I think, yeah, that's my answer would be establishing a level of confidence on how quickly you can get to 50 million, because it's important to get to that scale and pay fixed costs that are, they're essential to running the fund efficiently. And once you get to those levels, 50 million, 100 million, you can then call the retail platforms with more confidence and a higher success rate and get them to agree to allow the ETF to be distributed on said platform. And there's no shortage of model driven and ETF driven advisors out there. It sometimes becomes an issue of there's 3,000 plus ETFs and they have limited bandwidth. So they need some help from a home office level to screen, if you will, or filter what they can buy and what they can't. So getting to the point of success is quickly getting onto those platforms, not 3 to 5 years from now, but ideally inside of a year.
Right. Yeah. No, I couldn't agree more. And I guess just the one more last question with regards to this is like, okay, let's say you do all of those things, right? You have a successful launch, you get to 50, 100 million. You have, some pretty good, solid, committed clients. So you're covering your overhead. Is it time and patience and marketing and waiting for the right environment in order to maybe hit that home run or really start to scale? Or are there certain things issuers need to be doing on a daily and weekly basis to continue to kind of push the fund as time goes on?
Yeah, I like all the points that you mentioned in terms of being essential. I would recommend all of those, and I would add to it if one of the points that you made just simply doesn't line up with the current market, i.e., perhaps it's just a thematic strategy that's performing poorly in the short term. It's tough to sell something that has bad relative underperformance at that moment in time. I think instead of, well, we're just going to wait until performance turns around, or we're going to wait and see what happens and just, the phones are quiet until then, that's not a great strategy, because it's waiting and hoping, and the clock is running because obviously there are fixed expenses involved in running an ETF. I think the better strategy in that scenario, where you're simply just selling something that's out of favor or hasn't been embraced yet, and that's a common problem, especially with all the new ETFs out there, is to just look at what your best peers or competitors are doing, assess what's the collective AUM in my peer group. Is it $10 billion or is it relatively small because this is a new segment like the music segment? And is it several $1,000,000? What are my competitors doing? Perhaps what I'm not doing. What platforms are they calling on? What kind of marketing are they doing? Which conferences are they doing? What's their message look like relative to ours? Has anything changed, in the last 6 months to a year in the way they approach things? Have they had net inflows or outflows? I think that you can control to some extent the flows that you have in your own fund lineup, but it's ultra important to just look at who you think your closest peers are. And there may not be an apples to apples comparison in many cases, but that is probably the best source of intel, because eventually you can figure out how they're being successful, or perhaps you might identify a misstep they've had and capitalize on that. So I think just having an awareness on who you're selling against specifically. Is it a niche segment, like I said, the music industry, or are we competing in like an absolute return category, or something that's well populated like dividend growth equity, where there's no shortage of offerings there, and to stand out, it takes a lot, obviously.
Right. Right.
So I think you can kind of do that, day to day, week to week, quarter to quarter, and just examine net flows in your category and vis-a-vis your peers, and make some kind of assessment on what may be working or what's not working.
Well, Paul, I really, really appreciate your time. I thank you, for coming on and talking with us. And before I let you go, where can people learn more about, GTS and maybe connect with you?
Of course. I would recommend our website, which is just www.gtsx.com. That's Golf Tango Sierra X-ray.com. That'll give a good overview of the firm, our activities on New York Stock Exchange, our activities in ETF market making, and a genesis of the firm and everything overall. And if anyone does have interest, I send out an ETF weekly note every Monday, trying to keep up with all the progression in this industry as it's moving very quickly. And I'm sure that you can probably get in touch with me via Brad about that weekly note.
Well, Paul, again, thank you very much. I hope to see you soon here as conference season is going to be getting kicked off here as the winter months are slowly approaching.
Yeah, thanks very much for the opportunity, Brad. I always enjoy speaking with you and look forward to the next time.
All right. Well, take care. We'll see you soon. Bye.
Great. Thank you.